Our perception of money is changing rapidly, and banks are at the center of all of it. From how we access it, to how we buy, to how we trust that that money will be there when we need it. I'm Kiah Haslett, the creator of FinTech Takes Banking. Here on Bank Nerd Corner, I talk with bankers, economists, academics, and more about the complex dynamics shaping the financial services landscape. This week on Bank Nerd Corner, I'm joined by Heather Long, Chief Economist at Navy Federal Credit Union. The health of financial institutions and the economy writ large depends on healthy consumers, which is why I was thrilled to pick Heather's brain to learn more about how she's interpreting data in the labor market over the last 12 to 24 months. She drops phrases like K-shaped recovery and jobless boom. We also talk about the relationship between wages, job growth, and a healthy recovery, and how adding more AI tools into the workforce could impact those variables. Finally, we think about what financial institutions should be looking at and how they can stay close to their consumers. Hi, Heather. Thanks so much for joining me today.
Thanks for having me, Kiah.
Well, I am so excited that you are here to demystify what's going on in the labor market and trends. So my first question for you is, can you tell me a little about yourself and about Navy Federal Credit Union?
Yeah, sure. So I'm Heather Long, Chief Economist at Navy Federal Credit Union. We are the largest credit union in the United States with 15 million members and almost 200 billion in assets. We're also the largest credit union in the world, although I understand there's a big one in Brazil. And the really cool thing about working at a credit union is we are member owned. People often ask me, how can your mortgage rates be so much lower than what I see elsewhere? Or how can you be offering these certificate of deposit CD rates that are so much better than what we're seeing, particularly at the big banks? And it's it's because we don't have shareholders on Wall Street. We are not using our profits to pay shareholders. We reinvest in our business and especially reinvest in our members. Briefly, a little bit about my background. I am one of these, most people, if you know my name before, it's from my media days. I was an economics reporter for almost 2 decades at CNN and the Washington Post. I have a big following on X, if you will, and I'm proud to say I think I've tweeted every jobs report for the past 15 years.
Oh my God.
I know, nerd central here. Even after I gave birth to my daughter and was in the hospital, almost died. A few days later, I tweeted the jobs report. So that's how much I care about these topics that we're talking about today. And I've, had people in both the Biden White House and the Trump White House who told me, I watch your jobs tweets. So that's a little bit about me. I have a master's in financial economics and in medieval literature. That's my
naturally
from Oxford. I've got I don't know if you can see the video, but I have my Lord of the Rings Pez collection just behind us. So that's me in a nutshell.
Yeah. And I would be remiss for my bank listeners if I didn't mention that credit unions are tax exempt from paying federal taxes. Obviously, they pay state, local, and their employees pay taxes, but it always must be mentioned. But we are here not to talk about the difference between credit unions and banks, but to talk about a really, really important aspect of our economy, labor. And I imagine there's all sorts of economists. I had to take micro and macroeconomics in college. So how would you describe yourself as an economist, and what parts of the economy or questions are you interested in, and why?
Yeah. I'm definitely a little bit of a non-traditional economist. I do have a master's in financial economics, but my path was obviously very different from many other people. I think the biggest compliment for me, I have a lot of people who come up to me and say, I hated economics in college, but you make it fun, Heather. And I believe that economics is about people, not about math equations, although equations can be helpful. But, look, at the end of the day, what I think most of us really care about is what is happening in the nation and in our communities, and how does that impact our jobs, our pay, our housing costs, our ability to start a small business. And so these are the questions that have really motivated me. It's how is the middle class doing? And I've been calling this a jobless boom that we're in. What does that mean? What does it mean for the middle class? Are we going to see a pickup in hiring in 2026? What's AI going to mean for regular workers? So those are the stuff that I think about during my workday?
So those are really big, important questions. And I think one thing about labor is, it comes up a lot in bank reporting too, is like, this is actually something most people have an experience or a concept of in a way that maybe they don't always understand tariffs implicitly. They kind of understand, how do I feel about my job, my wages? How do I see people in my life getting jobs or getting laid off? They understand that most people, because they make their income through wages, understand very closely the relationship between employment, labor, and maybe their ability to participate as consumers and what their buying power is. And obviously there's, technology is changing this labor market so much. So first big question out of the way: what is the economy doing right now? Going back to your comment about the jobless recovery, like, what are some big questions that we should be thinking about very specifically in 2026?
Yeah, I think we're in a jobless boom right now.
Yeah.
And so the positive sides of that are the word boom. I mean, that's why the stock market is at record highs and going crazy every day.
Great.
And at the same time, it's why we have these, quote, hot GDP numbers that have been way better than expected. It's why recession fears have almost completely gone away at the moment.
Yeah.
But at the same time, people are scratching their heads. Why don't regular people feel this? And the reason is that jobless part of it, there has been virtually no hiring in America
Oh my God.
since April.
Yeah.
What hiring has happened has been exclusively in healthcare and a little bit in social assistance, which is kind of like the mental health of healthcare. And so, if you don't work in healthcare, it's bleak. It's bleak out there, as you talk about a lot on your show. And so that's playing out. It's not just hard to get a job right now. It's also playing out in the types of wages people are getting.
Sure.
Companies have more power now. They're forcing people back to the office. They're ratcheting back a lot of the flexibility we saw for the past few years when workers had more power. And ultimately, wage growth is starting to cool. It's not cooling a ton, but it's starting to cool a little bit. And I expect that to continue in 2026. So even if you keep your job, in this economy, you're going to feel squeezed. We're in the middle of a bit of a squeeze. So that's the up and downside of this jobless boom that we're in.
Correct me if I'm wrong. Jobless boom is probably not a great labor trend, not a great trend in the economy, but you're right. Like, I see that the stock market's doing well. GDP is expanding, and obviously the technical definition of a recession is 2 consecutive quarters of GDP contraction. So that's good. Can you, is this positive, negative? Like, how should I think about the phrase jobless boom, right? Like, should I be excited that that's my economy?
Well, look, it's better than a recession.
Okay, cool. Okay, so it's above that one.
Yeah, it's above that. But I think it's a really complicated period because a lot of what's going on right now is being driven by this AI boom that's going on that we're all pretty familiar with. And on the one hand, the AI boom and frankly, some of the innovations that happened even before AI coming out of the pandemic has caused rising productivity, which literally means we are all making more output per hour than we were a few years ago. Our employers getting good value out of all of us.
Awesome. Good for them.
So that's exciting in the sense that the last time we saw a really big productivity boom in the late 90s, it didn't just cause a boom in the GDP, it caused workers across the income spectrum to ultimately get paid more and to have more job opportunities. But the big question, of course, is that what's going to play out this time? So far, we're not seeing that. So far, there's the no hiring environment we've been talking about. The wage growth is not picking up. And so the question is there something that happens later this year that really starts to ignite those gains to the rest of America?
Sure. So you have been arguing that we are in what you're calling a K-shaped recovery. What does that mean? And how does that compare to other types of recoveries we could be having?
Yeah, it's really interesting. So the first time that K-shaped recovery really came on the scene was summer of 2020, right? In midst of pandemic. And basically what happened was this weird world where all the wealthy workers, the white collar jobs, they were able to go back to work remotely from their closet or whatever new home
Sure.
office they were making. And so a lot of the wealthier Americans were earning again, the upper part of the K, they were getting their income back. While the lower part of the K, think about all the restaurant workers who were laid off and retail workers and childcare workers, a lot of those lower income jobs were decimated. And there was
Hmm.
no hope that those jobs were coming back anytime soon. And those people, and they were unemployed, they were losing wages, they were worried about not being able to pay for their home or their car. And so that was when that true have and have nots
Right,
really
right.
appeared. Not that it hasn't always been there, but it was just so stark.
Yeah.
And but then we got all those government stimulus payments. There was the Great Resignation. Things sort of got better for a lot of lower wage workers.
Yeah.
And then something flipped again. And, you could argue it started in 2024, but it really became apparent in 2025. And that's when I argued there was a return of the K-shaped economy. And it's this return of, partly driven by the AI boom, the top 20% of America, the new dividing line in America is $170,000 a year. And
Okay.
people
Okay.
above that, we can see it in our data, you can see in the national data, they are spending like crazy.
Good for them.
I know, every
Must be
month it's
nice.
like, hey, let's throw a big wedding, let's throw a big birthday party for my kid, let's buy a new car. The bulk of cars now, new cars are purchased by these people earning these amounts of money. And meanwhile, what we see in our data, the middle tier consumer, they're still afloat, but they're feeling squeezed and they're shifting. I call it the Costco Christmas. They were buying a ton at Costco and TJ Maxx, trying to stretch every dollar that they have. And then you look at the bottom of the K, the have-nots, if you will. And these are sort of families, $65,000 and below. Obviously, it varies by where you live in America and how big your family is.
Right.
But Kiah, I kid you not, these people are spending less than they were a year ago.
Wow.
You can see the strain.
Yeah.
You can see that the reality of rising costs for healthcare, for childcare, for housing costs, and for electricity prices going up, and that they don't have extra money in their budget, and so they are literally pulling back on a lot of their spending. And so that's that K-shaped concept. And it's funny, economists, it took them a long time to get on board with this, whereas when I started talking about it, regular people got it right away. I would get so many emails like, this makes so much sense.
Yeah, and I do actually want to spend some time talking a little about kind of the maybe the delta between what data show. So stock market is like a quantifiable number every single day. GDP, a quantifiable number every single day. And then also like kind of the perception of like lived experiences, my sense that my cost is rising. I just saw, a report in Axios about grocery prices are higher today than they were in 2022. And some of the crazy making that you can have as a consumer, especially if you're not a baller at 170 a year, that you're just like, you're telling me things that I don't feel. And I remember when I first started reporting in 2011, this very slow recovery from, a very severe financial crisis, and how much work the administration was doing to say, like, genuinely, like, this year was better than last year, which was better than the year before. And it's actually a good thing that we don't have really rapid snapback growth. Like, this is like really good foundational growth, but the recession was just so severe. The foreclosures and lost jobs, these were so severe. So it's really not going to feel like 180 ever, probably. And you probably don't want it. And that was like, people didn't believe that either. And there were like political ramifications for this kind of like people just not really feeling like they were either sharing within the benefit, but also that like it wasn't true, right?
Yeah, what's that great line from Jeremy Maguire, "Show me the money"? I mean, I think really where a lot of middle class and moderate income Americans are. And you're right, a lot of people do go back to the Great Recession, over 15 years ago now, and they just see that they've had to survive crisis after crisis
Yeah.
after crisis. And you're right, every politician says, it'll be better next year, it'll be better soon when I get in office or when I do these policies. And for most people, it really hasn't been. They maybe
Yeah.
just make it. And let me put a few numbers on there's
Please.
a there, because sometimes I see pushback from experts who get on TV or whatever, and they sort of try to tell you that wages are growing faster than inflation. Yes, over the past, since the pandemic, wages on average have grown faster than overall inflation. But that's a big but. Number one, those are averages, so not everyone is at the average. Number two, most people, particularly in the lower income or moderate income range, are spending the bulk of their money on the basics.
Yeah.
And if you look at what I would consider, and most people consider the big five, your housing costs, your healthcare costs, your food, your groceries, your electricity, and then you can do childcare, transportation. If you look at sort of those core expenses, 4 out of 5 of them have grown faster than wages. And
Great.
that's where, like, you're citing the groceries, or certainly
Yeah.
the electricity prices skyrocketing. At Navy Federal, we run a cost of car ownership index. The cost of maintaining a car, even a used car, is shot up in the last several years. And so you're right. That's what real real America is feeling. And the other thing that I'll just throw out, one more thing, that you sort of alluded to it, is the squeeze that people are feeling. It's partly from what we've just been discussing, all these core costs going up, but it's also in the past year, inflation overall has risen and wage growth has started to cool a little bit.
Yeah.
And so, there literally is a squeeze. Wages are cooling and prices are rising, and whoop, I wonder why people are so upset.
Well, Heather, I was told that one of the contributors of inflation was wage growth. And how is it now that we have some inflationary pressures without wages contributing to them, right? Like, what did we kind of see, going back, if you can go back, about how wages contributed potentially to inflation in 2021 and 22? And then why aren't wages, if we're getting so much more productive and if we're contributing so much to the economy and GDP, why aren't wages increasing?
Yeah, let me start with your last question, because that's the one that's the real burn.
Yeah.
Every quarter, the U.S. government puts out a report showing the share of the national GDP, so the big pie, if you will, and what proportion is going to labor, to wages, basically, and what proportion is going to capital, to the machines and particularly the owners, the Wall Street type owners of capital. It is at a record low for the share that's going to wages and labor.
Great.
And so you can feel it. That's something that I think people feel instinctively, but there actually is data that backs up how this imbalance, if you will, or the shift built towards where's the money for labor? Why isn't labor experiencing more of an uplift in this era when we're more productive and people have hung in there for their jobs in America? And so, look, I think there's a couple of things that are going on. From the economic research, overwhelmingly shows that the main driver of inflation coming out of the pandemic was not paying your Uber driver a little more, or paying your,
it wasn't saving the restaurant in my neighborhood through my takeout orders.
Yes. Yeah, we wish we had done more of that in hindsight, right? I should have tipped 25 or 30% instead of 20. But it was the supply chain glitches, if you will. That was the number one contributor. And the same thing is happening in the past year. It's the main tariffs have certainly been a key part of the inflation story. The goods inflation has gone up. We can see in our data that consumers have responded to that. They're not buying as many couches. They're not buying as many home appliances, because those are the areas where the prices have been passed through the most. But you're right. So I think there was a worry
Yeah.
that paying employees a couple dollars more, particularly on the lower end, was really going to tank America. Instead, that was not the main driver of inflation. And as we've all seen, companies have still managed to do record profits,
Sure.
even with the wage growth that we have seen.
So you mentioned AI. I too have seen how AI, like within companies, and also is influencing productivity and maybe potentially hiring. And I have also seen how AI from in the stock market is kind of probably punching above its weight as far as the direction that markets move every day. If AI is making us more productive, but we're in a jobless recovery, is AI bad for labor?
I think that's a question that we frustratingly can't answer sitting here today.
Okay.
It feels like in a couple of years we'll know the answer to that
Oh,
question.
great. Okay, cool.
Or we'll all be patting ourselves on the back, right? Again, we could be in a world where in a couple of months or in the next 12 months that people finally realize that AI can do a lot, but it can't do it all.
Sure.
And they start hiring again. They start, and they realize, okay, we didn't have the recession. Some of this uncertainty is behind us from political world. And now we need to look to the future and we need to grow, be back in growth mindset. That could easily happen. But there's this other story which hangs in front of all of us, which is, whoa, could this actually come for the jobs? And one of the biggest aha moments I had recently was realizing that what I think happened, it's not that AI at the moment is displacing jobs. It's not taking your job or my job today. What happened in 2025 and early 2026 is, companies have a limited amount of dollars, right?
Sure.
They've got their own pie.
Yeah.
And they spent a huge amount of that pie last year on AI investment, on the capital spending, the business investment. And what does that mean? They simply didn't have a lot of money left to go pay employees, right? To go and hire. And so it wasn't so much that AI was eating all the jobs last year, but AI was impacting the hiring decisions in the sense that there was so much money going to the tech, there wasn't money to hire.
Okay.
And so that's the big question for me. Does that start to change in 2026? Do we either have such a boom that there's such a bigger pie that we can start hiring again because there's just more money all around for tech and hiring?
Yeah.
Or is there something truly different this time where companies start to say, we don't need Heather and Kiah and whoever else. Like it's a whole new world. And at the moment, a lot of economists, and I put myself in that camp, are skeptical that AI can can truly replace most workers right now.
Well, I've seen anecdotally concerns that AI can do really good entry-level work, which means that, there might be some concerns around the availability of jobs at the entry level, especially for, recent college grads where there's still some training components to the job and that you kind of can't become, mid-career or senior in your career without first being early in your career. Do you have a sense of what segments of the economy are really important for driving job growth? And then also maybe, if we think about AI kind of changing different, segments of the economy or even just, different entry level, like the entry level thing, kind of what trends would we be looking for if we wanted to kind of see, if this is the trend today, in the future, that we could see growth or we could see contraction?
Yeah, there's a lot there. I'm with you. Like my initial read on the AI was, it's impacting entry level. And certainly the research that has come out of Stanford and some other places that's been pretty good. Yale Budget Lab's done a nice paper, has pointed to the only concrete evidence so far being computer coders under 30, so the more entry level. And the other one that people forget is customer service representatives.
Sure.
Your phone, people on your first line of phone calls. And again, it's been the under 30-year-olds, right?
Yeah.
The people would have handled the very basic stuff. and that AI hasn't impacted much outside of that. I will say I always pay attention, and I'm not as shrill for them, but this is just like personal interest. I always pay attention to
Okay.
Anthropic's economic index. They're putting out some of the most cutting edge data about how people are using their platform, their Claude service.
Yeah. Yeah.
LLM, and you can even go on, they list all like 900 different professions. You can type in podcaster or economist or whatever your job is, and you can see they will tell you what percent is augmented of the job versus truly replaced,
Yeah.
not using AI at all.
Oh, interesting.
Yeah, I mean, again, is it perfect? No, we can all
No. Yeah.
holes in it, but it's the best thing out there so far. And the reason I'm giving this long-winded spiel is they just put out some new research here in early 2026, and it actually shows that middle tier jobs, so the jobs with sort of the 10 to 25 year experience, that they're starting to see more disruption and more use and more ability for Claude to be able to do those jobs. And
Great.
that is we'll see. Again,
Yeah.
there's early evidence, but I mean, obviously I'm kind of in that sphere, so that's my interest personally, but
Perfect.
I think it really shifts the narrative on the head.
Yeah.
We've all internalized, oh, it's just entry level. That's really impacted.
Right. I mean, yeah, I'm on record as being a big AI skeptic, mostly because I think I feel like I react to to hype. And so right now I think AI is kind of overhyped in its promise and underhyped in its harm, or underweighted in its harm. And I think that while also, always is productivity the thing we should be pursuing the most, and thinking about how does one learn and grow. But, also my question is thinking about AI and how AI might be influencing labor is can you grow an economy without growing jobs? And also, do we want that version of the economy, right?
I think here's how I would say it. There is a potential version down the line that you would want. Like when I have a young daughter, and when I think of, what my daughter, or if she ever had a grandchild, what that grandchild could be doing, and sort of many, many years down the line. There is a world where, robots could do most of the work. We could tax the robots and we could all have more leisure time. That was sort of like the vision, coming out of the Great Recession, of universal basic income, but wow, getting to there is, I think we're seeing a little bit of this through the K-shaped economy concept. There's a lot of turmoil, a lot of change, a lot of political frustration that plays out because we have organized society and most of our lives and most of our identities, for better or worse, around a day job and around a 40-hour-a-week type job. And there's a lot of flaws to that.
Yeah.
But that's the way that most people still think of themselves and think of their role in society. And so you're right. I don't think you can have healthy growth without job growth. And so many people feel stuck right now.
Right.
You hate your job, it sucks because you can't go find another job. It's really hard, or it takes a long time, or if or we're just not dynamic. There's so many people who maybe they're one thing and they want to transition to another, and they would be better utilized in these other skills. And you can't do it right now. And so that's not healthy long term, both on the personal level, how we utilize talent, how we grow talent, and certainly on the big picture level, it's not healthy for society.
Well, and you think too about what you said about the lowest earners, and maybe if that started inching up, we're not even really talking about housing affordability, right? But there's a lot of interest from different parts of the political administration about how people just aren't buying homes. And I think about one, the reason why homes are so important. One, people live there. Two, it's the largest financial asset most people acquire in their lifetimes. And then I personally live in Nashville, and I've seen, housing prices triple in 3-4 years. And that's unsustainable for most people because their incomes aren't tripling. And so when you think about kind of the downstream impacts, like what does it mean that wages might be stalling? What does it mean that we might have a jobless recovery? People like me maybe won't become homeowners, or that will be a very long delayed thing. And so you don't get the financial appreciation. But also I go back to thinking about, again, post financial crisis, people were kind of stuck in their homes and they didn't want to sell at a loss. They didn't want to move. And so it really kind of was disruptive. It just, the mechanics of leveling up where the gears were rustier, in part because of an undue weighting of how much the home was playing into those decisions. And I wonder, too, if we're just going to get a different version of that as a downstream impact from what we're seeing in these labor trends today.
Amen. I think what you're saying is so smart. I mean, I'm on that millennial generation that's impacted. I did live with my parents 20 years ago.
Yeah, do what you got to do.
Early in the early stages of it, when it was not so common, and I would sort of whisper to people when they'd ask where I lived. I was like, well, and you're right. And not only did it play into people's how they thought about, there was a lot of pessimism, and it also ultimately played into my generation having fewer children, delaying marriage, delaying home ownership, having kids later, and ultimately having fewer children. So this had all these downstream effects that weren't thinking about at the time. And I think the way that I see it, I'm curious your view, playing out in Gen Z seems even more pessimistic about whether the economy can ever work for them. Millennials like me, we just delayed it all. Everything was like delayed development. And I feel like Gen Z is just looking at all of this and saying, it's never going to happen. Like, I've lost all hope. And some of that reaction is positive because they don't put as much emphasis on work, broadly speaking. They like to have more broader view of what the meaning of life is and where to find value. They sort of reject consumerism. I love these no-buy trends and dry January trends and all of this sort of rejection of some of the consumerism. But yeah, it's a totally different. Is this just like millennials and one day they're going to wake up at 30 and they're going to change their mind? Or is this, that we're going to have some really broad changes to society and work? Oh, I know, you're on such a roll. Oh, thank you.
Wait, Heather, could you hear me?
No, that's why
God damn it. Oh my God.
I know, I feel like bomb and we all missed it.
I'm marking that so you can just go ahead and cut out that whole thing of silence. Okay, that's fine. I can restart this. I did actually say that I try not to talk to Gen Z people if I can avoid it. So I won't say that this time. God damn it. That's so funny. I'm sorry.
I know, you were like, oh,
I was
really?
totally on a roll. Okay. All right, I'm going to restart this answer. I totally think one thing that's so interesting is you and I are millennials, and we came up in this, in the wreckage of the great financial crisis. And I like to joke that we're the only good generation because the Gen Zers that are coming up have, they're kind of encountering not even that bad of a financial crisis, but I've heard the phrase applied of financial nihilism, that, and they have this, they're entering the workforce, they're going through college and entering the workforce with a financial nihilism that they might not think that they're going to get a good job. And they might not ever like buy a house, right? Like it's just not even, it's not us delayed living with our parents, kind of making it work because we graduated after a recession. It's never going to happen for me, even if the economy is quote unquote good. And so you see that in like some of the prediction markets, or you see that in how they're spending money in some regards. So like there might be some that are like, oh, I have a different relationship to work, and that's great. My identity is not defined by that. But also, my relationship to work means I'm not really investing in that future self because I actually don't think I'm gonna ever retire, or I don't think I'm gonna ever buy a house. And so you might like have these downstream demographic shifts kind of tied to a person or a group's perception of the labor market and of their ability to kind of advance and be a meaningful player in it.
Yeah, amen. I agree with you. And, one of the big questions for 2026 is do things get better particularly for entry-level workers? No.
Yeah.
And I always say that because, look, we keep referencing, the two of us obviously remember very profoundly those days just after the great financial crisis, when I was living in my parents' basement. And I think it was a really tough 2 or 3 years to get hired. And the unemployment rate for young people was actually worse than it is now. A lot of people forget that. It was worse for millennials.
Yeah.
And so, but then it got better. Then it did get better. And there was sort of these 2 or 3 rough years, and then there were opportunities again. And so that's kind of my question. I can tell a positive spin that things will get better in 2026 and 2027, and that the class of 2026 and class of 2027 will fare much better, and that this will have been a temporary blip. But it's not that hard to tell a story where these troubles keep going and this nihilism really gets embedded.
Yeah. Well, one thing that I was thinking about, and I mentioned it earlier, this K-shaped economy, there's like kind of a top line and a bottom line.
Yep.
Navy Federal is mostly consumer, but I would say like 100% consumer. You don't have that kind of element of the commercial. And so you guys might have a pretty good look at how consumers are faring. Now, military is a little different than I think people who aren't military, but 100% military. How do you make sure you're getting that bottom line data so that it's not just GDP or overall like jobs numbers every month, and you're getting you're able to maybe segment by income or age?
Yeah, that's honestly been one of the main attractions to this job for me. When people say, "Oh, don't you miss being a journalist?" I'm talking to people all the time.
No one misses being a journalist. Get out of here.
I'm like, well, I don't miss working for Jeff Bezos, but I think, look, I think you're right. What's exciting for me about being at Navy Federal is we do have 15 million members. The vast majority of them are middle class earners. And I can see in real time every day what their credit and debit card transactions look like, how many of them are calling in to borrow money or to ask whether it's for a car or a house or a personal loan. I also spend a lot of time talking to our frontline staff. We do not use very much call center AI. We use a little bit, but it's very easy to get to a person. We have excellent customer service. Yeah. And so I have multiple calls every month with our frontline staff. And one of the things that they flagged to me that was just mind blowing, for me at least, was when they said, something that's different, Heather, is I'm starting to have people call in to ask for personal loans to pay their property tax and their car insurance.
Oh no, that's not a good sign.
No, it was not a good sign. That's the bottom of the K that's really struggling. And it's a reminder that some of these costs, some of which are not captured, like property tax in the CPI inflation index, these are costs that you have to pay. And, they've gone up substantially for people. And that's that squeeze we keep talking about. That's that pressure that people are feeling. So you're right. I think it's very important to look at all of this data, including the phone calls.
Yeah. Yeah, I worry. I mean, I actually really do worry in these moments where there is this perception gap, is to just make sure, like, well, if you think everything's good, are you looking at things that would indicate it's bad? Or if you're looking at things that are bad, like if you're a pessimist like me, are you making sure you're not just maybe overly focusing on anomalies? I wrote a 2-part piece about credit risk, and I have my own bias, but I actually wrote credit risk is rising and credit risk is okay. Like credit quality is fine and rising. Because I just wanted to make sure, like, the picture's just kind of messy, and it's okay if you kind of gravitate towards one thing, but you should probably make sure you're at least you see all of it. But I do really worry with, when people talk about the economy, like how are they defining, scoping, measuring?
Yeah.
What are and like also how do they weight the things that they think are good and the things that they think are bad?
Yeah, I agree with you a lot. Averages are very masking, and most of our national data are averages. Some interesting point, just riffing off what you just said. I will say, so as you mentioned, we obviously have a lot of military members. It's not as many as, we have 15 million members, and a couple million are military. But here's where I'm going with this.
Yeah.
People may remember the warrior bonus that was given out, $1,776 from the president that landed in military accounts just before Christmas.
Okay.
And I can tell you from what we saw, and we got quite a few of those into direct deposited, about 40%, quite a substantial number, people immediately used them to pay down credit card debt. Now, that means they had credit card debt to begin with. But I think what gives me a little bit of hope in the near term on the credit side, we are about to see these bigger than expected tax refunds for most Americans, particularly lower moderate income Americans, $500 to $1,000 more on average. And if we see similar trends to what we saw with the warrior bonus and what we saw with the stimulus payments, a lot of people will be able to pay off some debt. To put it towards those immediate crisis needs. And so I think that will stave off, at least for a while in 2026, some of those worst case scenarios, even for the bottom of the K.
Sure. Yeah. So, we've had this long conversation about labor, and that doesn't directly relate to banks unless banks are thinking about hiring or laying off or AI. But one thing I really enjoy about being a bank reporter is you do have to understand different aspects of the economy to understand what that means for banks. And I think it's not controversial to say that a healthy economy and healthy consumers mean banks are strong and probably growing, or that like the growth is the good kind of growth. I'm sure Navy Federal is happy to have loan growth, but is not happy that they're making a personal loan for, property taxes. That's not how you want your, to grow your loan book, right? What should banks be thinking about, especially banks that have large consumer bases? And how would you say that they should maybe assist their consumers? And what should they be kind of concerned about if there's this weakness potentially in consumers?
Yeah, we've been spending a lot of time thinking about it. Obviously, there's this huge backdrop of the affordability crunch that's going on, and it's going to dominate the political conversation in 2026. It sounds so basic, but there's so many ways. There was a Nobel Prize award in economics for the nudge theory. How do you nudge people to do the right things? And banks play a huge role in that, and credit unions. And that's it sounds so basic, but trying to innovate ways to get people to save more.
Yeah.
And so we've been experimenting some with that. We've gotten a bunch of new tools that will help you manage your subscriptions, that will help you, free budgeting apps. We offer free financial counseling to people. A lot of people, they don't want to pay a ton of money and have a permanent financial advisor, but they need that check-in, almost like your annual health physical. I always say, do your annual financial physical. And so I think those are some less obvious ways, but that actually make a really big impact. You're right that it's been encouraging to see some pickup in the real estate lending space. So in particular, we've been calling it a mini boom in refinancing. I just had someone call me today like, hey, your rates look really good. Who should I call?
They're not calling you, right? They're not, Heather, can you rewrite my mortgage for me?
The right person. I probably can't process your refinance here. But so I think it's not, I think there's a lot of encouraging, I've been calling it a thawing year. after many frozen years on the real estate side. And the hard part for banks right now is these proposals that have come out. The 10% cap on credit cards would obviously alter every financial institution's algebra going forward, at least for the next year. And so what plays out with that, I think is on a lot of people's minds. And it's still very uncertain at least at the time that we're talking. Those are some things on my mind.
Yeah, I think one of the real takeaways from this conversation, when we think about financial institutions, chartered financial institutions, and then we think about the ecosystem of financial technology around that, one of the reasons why I think financial technology has exploded is this idea of consumer health and financial wellness. And there are enough, I think, tools now, there's enough data. Financial institutions can be really close to their customers and help these customers understand their financial health. And also, this is becoming increasingly imperative because if you don't do anything today and your consumer maybe loses their job or their customer loses their job or isn't able to grow in their career and doesn't feel connected financially to their future, that will, again, have downstream impacts to the financial institution itself, right? And so as much as possible, banks and credit unions need to be kind of nurturing their growth or maybe helping the consumer direct and making these good, healthy choices easier. Whereas, I think about the prediction markets and sports betting and buy now, pay later and earned wage access. All of these financial tools are helping separate consumers from their money. And who's helping consumers keep their money and slow down the velocity of their money and age their money and grow it outside of just pure wages, right? Yeah. So what is your advice for financial institutions as they think about how they'll grow in 2026, given your view of future economic growth?
Yeah, I agree with you. I mean, it's something that certainly we believe in, but I'll quote the podcaster and TikToker, your Wall Street BFF, whatever her name is. But she had a great line, and she always says, saving will not make you rich. It's only the first step. Yeah. And you have to actually put your money to work, like you're saying. You have to save it first, but then you have to invest it or at least get it in a CD that's earning a good amount. And but that's two steps that you have to do. And a lot of people falter on both of those steps.
Exactly. Well, Heather, thank you so much for helping us understand the very weird economy that we're in right now, as well as some of the trends we're seeing in the labor market. I would love to have you back on in the future so we can do a temp check of what's been happening. But thank you so much for joining me today.
Well, thanks for having me. Yeah, we'll have to chat Chaucer next time. Thanks.
Thanks. Thank you for listening to this episode of Bank Nerd Corner. Stay up to date with news and trends in the bank space by subscribing wherever you get your podcasts. Also, if you love FinTech Takes Banking, please tell a friend. Talk to you next time.